Gold just had its worst week since 1983. Not during a banking crisis, not during a recession. During a war. Oil prices exploded, stock markets buckled, and gold, the one asset that every textbook says should surge during exactly this kind of crisis, did the opposite. It crashed. From its all-time high, near $5,500 an ounce, in late January, gold has fallen more than 20%. In a single week in March, it dropped 11%. Silver got hit even harder, down 30% from its highs, collapsing below $70 after surging above $120 just weeks earlier. This is the moment that is supposed to be gold's time, a hot war in the Middle East. Oil above $100 a barrel, inflation fears surging, central banks scrambling. Every condition that should send money flooding into the oldest safe haven on earth is in play, and yet investors are running the other way. The question everyone is asking is simple: why? And the answer reveals something most people have never been told about how gold actually works in the modern financial system. Because gold did not crash despite the crisis, it crashed because of it. The same war that should be gold's best friend is pulling apart everything that held the gold price up in a way most investors have never seen. This is not a failure of gold. This is a failure of what people think gold is. And by the end of this, you will understand the difference between the story and the machine, and why that difference matters more right now than it has in 40 years. The Dutch bank ING put it bluntly in a research note this month. Gold, they said, had been trading more like a meme stock than a safe haven. Upward momentum faded. Investors who had piled in during the rally, retail traders, short-term speculators, people who had no business being in gold long-term, were now selling to raise cash or rebalance their portfolios. And the numbers back it up. Gold rose 67% in 2025. That kind of run does not attract long-term holders. It attracts tourists, people chasing momentum, people who had no intention of holding gold through a war, they just wanted to ride the wave. Steve Sosnick, the chief strategist at Interactive Brokers, said what many were thinking. It is hard to justify calling something a hedge when it has double-digit swings. And he is right. When your safe haven drops 11% in 5 trading days, the word safe stops meaning anything. But here is what most people miss. The problem is not that gold failed. The problem is that the war created a chain reaction, one that turns gold from an asset you want into an asset you have to sell. And that chain starts not with missiles, but with oil. When bombs started falling on Iran, the immediate effect was not on gold. It was on oil. The Strait of Hormuz carries roughly 20 million barrels a day, enough to fuel every car, factory, and power plant in America and Europe combined. When it shut down, 1/5 of the world's oil vanished. Overnight, Brent crude surged past $100 a barrel for the first time in nearly 4 years. It briefly topped 119. On March 19th, it closed at $108.65. That oil shock did not stay in the energy market. It bled directly into inflation, and inflation is the thing that kills gold. Here's the chain. Oil goes up. Transportation costs go up. Everything that gets shipped, which is everything, gets more expensive. Food, fuel, chemicals, building materials. Inflation, which had been cooling for months, suddenly has a new problem, and not a demand problem, which the Federal Reserve knows how to fix. A supply problem, which it does not. The Fed met on March 18th. They held interest rates at 3.5% to 3.75%. But the real news was buried in the projections. The Fed raised its inflation forecast for 2026 to 2.7%, up from 2.4% just 3 months earlier. Core inflation, strip out food and energy, just look at everything else, also jumped to 2.7%. And the dot plot the chart where each Fed member marks where they think rates are headed told the real story. 7 of 19 members now expect 0 cuts this year. Not 1, not 2, 0. Before the war, markets had been pricing in 2 rate cuts. Now they are pricing in 1 maybe. Traders briefly priced in a 40% chance of a rate hike before year end. Not a cut, a hike. That is how fast the outlook flipped. This matters for gold because gold pays no interest. Nothing. When you hold gold, you are choosing to hold an asset that generates no income. That choice makes sense when interest rates are falling, because the alternative bonds, savings accounts, money market funds is paying less and less. But when rates stay high or threaten to go higher, every day you hold gold costs you money. The 10-year Treasury yield surged to 4.4 to 2%. That is real competition. 4.5% guaranteed by the United States government versus 0 from a bar of metal sitting in a vault. The war did not just create fear. It created the one kind of inflation central banks cannot fix, with rate cuts, prices rising because supply disappeared, not because people are spending too much. And elevated rates are the single most powerful force working against gold. The conflict handed the Fed a reason to stay tight. And staying tight is devastating for gold. Chair Jerome Powell said it during the press conference. 4 or 5 members shifted from expecting 2 cuts to expecting 1. He was careful with his words, but the message was not. The Fed is not coming to rescue gold. Not this quarter, probably not this year. And every month they stay on hold is another month where treasuries and money market funds look more attractive than a non-yielding metal that just lost a fifth of its value. The irony is almost elegant. War is supposed to be gold's greatest ally. But this war, by sending oil higher, by reigniting inflation, by freezing the Fed in place, has become gold's most effective enemy. The same crisis that should be driving money into gold is the reason money is leaving. Rising rates explain why gold became less attractive, but they do not explain why it fell off a cliff. For that, you need to understand what gold actually is in 2026. Not what it used to be, not what people think it is, what it is. Most of the gold that trades every day is not gold. It is paper, contracts, digital entries on a screen. When you look at the gold price on your phone, you are not seeing what a gold coin costs at a shop. You are seeing what Wall Street traders are willing to pay for a bet on gold, and they are moving billions in milliseconds. And the vast majority of those traders are leveraged. They are borrowing money to amplify their bets. This works beautifully on the way up. Gold rises 67% in a year, and borrowed money turns that into even bigger profits. But when the price turns, leverage works in reverse. Gold drops 1%. But if you borrowed $20 for every one of your own, that 1% just wiped out a fifth of everything you have. And when that happens, the phone rings. Your broker is not asking how you feel. Your broker is telling you put up more cash in the next hour, or we sell everything you own. No negotiation, no extension. Now multiply that across every trading desk, every hedge fund, every algorithmic system holding leveraged gold positions, all of them facing the same margin call at the same time. What happens next is not a decision. It is physics. Everyone sells, not because they stop believing in gold, because they have to. And the asset they sell first is the one that is most liquid and most profitable. After a 67% rally, gold is both. This is exactly what happened in the first week of March. On March 4th, the SPDR Gold Trust recorded a single-day outflow of $2.9 to $1 billion, the largest since 2016. In 7 days, the fund lost 25 tons of physical gold, not because investors changed their minds about gold's long-term value, because they needed cash, right now, and gold was the fastest thing to sell. One analyst at Seeking Alpha described the precious metals market as dangerously over-leveraged, with hundreds of paper claims existing for every physical ounce of silver. The structure is similar for gold. When that kind of leverage unwinds, it does not matter what gold is worth. It matters what gold can be sold for right now, in the next 10 seconds, before the margin call triggers automatic liquidation. This is the mechanism hiding beneath the headlines. Gold did not fall because investors lost faith. Gold fell because its own liquidity, the thing that makes it the world's most trusted crisis asset, turned it into the world's most convenient source of emergency cash. The selling was mechanical, forced, and completely indifferent to fundamentals. The physical market told a completely different story. Premiums on coins and bars stayed elevated. Jewelers and institutional buyers maintained demand. Central banks, the biggest structural buyers of gold over the past 3 years, did not sell a single ounce. The disconnect between the paper price and the physical reality is not a footnote, it is the entire point. Price discovery in modern gold happens in electronic markets. And in electronic markets, leverage and margin calls set the price, not supply and demand, for actual metal. The GLD fund lost over $6 billion in assets across 3 weeks, and it was not alone. Gold-backed ETFs across the industry saw outflows measured in billions, the largest wave of redemptions since the fund's inception. Meanwhile, on the other side of the liquidation, something revealing was happening. Bitcoin ETFs gained over $1.5 billion during the same period. Not because Bitcoin is a better safe haven, because Bitcoin had not just rallied 67% and was not sitting at the top of every margin call list. Gold's popularity was the weapon used against it. The cascade had a name among market professionals. They called it longs, liquidating longs. Each forced sale pushed the price lower, which triggered more margin calls, which forced more sales. A self-reinforcing spiral that had nothing to do with whether gold was overvalued or the war was bullish for metals. The machine did not care about fundamentals, it cared about collateral. So if money was flooding out of gold, where did it go? The answer is the least exciting investment on earth: money market funds. These are ultra-short-term vehicles that hold treasury bills and government-backed debt. They pay a yield north of 3.5%, they never lose value, and they can be liquidated in hours. By the third week of March, total assets in U.S. money market funds had reached approximately $8 trillion, a record. The Investment Company Institute reported that in the single week ending March 18th, money market fund assets jumped by nearly $39 billion. Government money market funds alone attracted over $40 billion in that 1 week. That is the new safe haven. Not gold, cash. When real yields are rising, meaning treasury bonds offer returns above inflation, gold loses its primary advantage. Gold cannot compete with an asset that pays you a guaranteed return backed by the full faith of the U.S. government. And right now, with the 10-year yield at 4.4 to 2% and inflation expectations climbing, real yields are among the highest in years. The dollar told the same story. The U.S. dollar index strengthened roughly 2 to 5% since the war began, depending on the measure. A stronger dollar makes gold more expensive for every buyer outside the United States, which is most of the world's gold demand. Buyers in Tokyo, Mumbai, London, and Frankfurt saw their purchasing power shrink just as gold's appeal was already fading. It was a double hit. The asset costs more, and it pays nothing. This rotation from gold to cash and government debt is not irrational. It is coldly logical. In a world where inflation is being driven by a supply shock, not by money printing, the usual playbook does not apply. During the pandemic, governments printed trillions of dollars and sent checks to every household. That kind of monetary expansion is rocket fuel for gold. But this time, inflation is coming from oil from a physical disruption to supply. The Fed is not printing money. It is keeping money tight. That changes everything. In a tight money environment with rising yields, gold is at a structural disadvantage. The BlackRock Investment Institute put it starkly in a client note. Government bonds and gold, the two assets that are supposed to hold your portfolio steady when stocks fall, are not doing their job. That sentence would have been unthinkable 2 years ago, but it is the reality of March 2026. The old safety net has holes in it, and the numbers tell you exactly how big those holes are. While gold-backed ETFs were bleeding billions, short to intermediate government bond funds and investment-grade bond funds pulled in billions in fresh capital. The rotation was not subtle. It was a visible, measurable stampede from one side of the safety trade to the other. Investors did not stop wanting safety. They stopped believing gold could provide it, at least in the short term, when Treasuries were offering 4% with zero downside risk. The fear trade did not disappear. It just changed address. If you have been watching all of this and feeling a growing sense of dread about gold, here is the part that changes the picture. This has happened before, almost exactly like this. In March of 2020, when COVID shut down the global economy, gold did not immediately surge. It crashed. Between March 9th and March 19th of that year, gold fell approximately 12%. Investors were not selling because they lost faith in gold. They were selling because they needed cash to cover margin calls, to meet redemptions, to survive the worst liquidity crisis since 2008. Sound familiar? That crash lasted 10 days. By the end of March, gold had already begun recovering. By August of 2020, it hit new all-time highs above $2,000 an ounce. The people who panicked and sold at the bottom missed one of the greatest rallies in gold's modern history. Go further back. During the 2008 financial crisis, gold dropped roughly a third from its peak to its trough. It fell alongside everything else during the Lehman Brothers collapse, and then the Fed stepped in. Quantitative easing began. Interest rates went to zero. Gold rallied 165% over the next 3 years, reaching $1,921 in September of 2011. The pattern is consistent enough to be predictive. Acute liquidity crisis triggers forced selling. Gold drops alongside everything. Then the structural drivers reassert themselves: monetary expansion, currency debasement, institutional demand, and gold not only recovers, but reaches new highs. The structural story has not changed. Total gold demand in 2025 exceeded 5,000 tons for the first time in history. Global gold ETF holdings grew by 801 tons. the second strongest year on record. Central banks bought 863 tons, with 230 tons in the fourth quarter alone. Poland added 102 tons. Kazakhstan bought a record 57 tons. Brazil re-entered the market for the first time since 2021, adding 43 tons. 22 central banks increased their gold reserves by at least 1 ton during the year. These are not momentum traders. These are sovereign institutions buying physical metal for national security reserves. They did not sell during the crash. They are not going to sell. JP Morgan maintained its year-end 2026 gold price target at $6,300 an ounce. Deutsche Bank held at $6,000. Neither institution revised their targets despite the correction. Both described the pullback as a tactical event inside a structural bull market. Ed Yardeni, one of Wall Street's most experienced strategists, kept his target at $6,000 while acknowledging he would reconsider only if gold continued to defy expectations. The correction is real, the pain is real, but the foundation underneath gold de-dollarization, record government deficits, central bank accumulation, and a world that keeps generating crises has not cracked. And there is a detail in the data that most people overlook. During the worst of the selling, physical gold premiums stayed elevated. Demand from coin buyers, jewelers, and institutional allocators did not collapse. The physical market held. It was the paper market, the futures, the ETFs, the leverage swaps that broke. That divergence between paper and physical is historically one of the clearest signals that a sell-off is driven by structure, not by substance. When the paper clears and the leverage resets, the physical floor tends to hold. It happened in 2020. It happened in 2008. The script is the same, only the crisis is new. So here is the paradox, and once you see it, you cannot unsee it. Gold is falling because it is good at its job, not despite it, because of it. Think about what makes gold a safe haven. It is liquid. It is globally recognized. It can be traded 24 hours a day in massive volumes. It settles quickly. It has deep markets. There is always a buyer. These are the qualities that earned gold its 5,000-year reputation. But those exact same qualities, the liquidity, the depth, the ease of selling, are what make gold the first asset to get dumped in a margin call. When a hedge fund needs emergency cash to cover losses in equities or oil derivatives or currency positions, it does not sell its illiquid real estate. It does not sell its private credit holdings. It sells gold, because gold is the one thing it can sell right now, at full price, with no counterparty risk. Gold's greatest strength is its greatest vulnerability. The thing that makes it safe to own is the thing that makes it dangerous to hold during a leverage unwind. The World Gold Council published data showing that gold posted positive returns in only 64% of weeks when geopolitical risk spikes sharply. That means more than a third of the time during the exact moments people expect gold to protect them, it does the opposite. Not because gold is broken, because gold is liquid enough to be sold when everything else is not. This does not mean gold is a bad investment. It means gold is a misunderstood one. The popular image gold as the fortress you retreat to when the world burns is incomplete. Gold is more like a fire extinguisher that also happens to be made of cash. During the fire, people grab it not to fight the flames, but to pay for the damage. And when the fire is out, they buy it back, every time. That is the pattern of 2020. That is the pattern of 2008. And the structural forces behind gold central banks buying hundreds of tons a year, government debt spiraling past any hope of repayment, the slow and steady erosion of trust in fiat currencies, these have not changed because of one correction. If anything, the Iran war has strengthened the case. More geopolitical instability, more energy insecurity, more reasons for sovereign institutions to hold an asset that no government can freeze, sanction, or print. The question is not whether gold will recover. History answers that clearly enough. The question is whether you understand what gold is and what it is not well enough to hold through the moments when the machine turns against it. Because the next time a crisis hits, gold will almost certainly crash again first, and then it will almost certainly recover. The people who understand the mechanism will hold. The people who believe the myth will sell. And the distance between those two groups is the distance between losing money and making it. Before we wrap up, and this is not financial advice, this is the mechanism talking, there are 3 things worth understanding if you own gold or are thinking about it. 1. Watch the Fed, not the war. Gold does not move on headlines, it moves on interest rates. As long as the Fed holds rates above 3.5% and inflation stays hot, gold carries a cost every single day you hold it. The moment the Fed signals cuts, That is when the math flips. 2. What you hold matters more than whether you hold. In every major crash 2020, 2008, and now people who owned physical gold wrote it out. People who owned leveraged paper got liquidated. Same asset, completely different outcome. If your gold can receive a margin call, it is not a safe haven. It is a trade. 3. Central banks are not selling. 863 tons last year, 230 in the fourth quarter alone. 22 countries adding to reserves. These are not traders. These are governments building a floor under the gold price that did not exist 10 years ago. They are still buying through this correction. Does that mean gold recovers tomorrow? No. Does it mean the structural case is broken? Not even close.